Well, welcome back, everybody, to the next session on discussing the question of whether shareholders can rescue capitalism. And I'm Tom Gosling from London Business School, and delighted to be facilitating this next session. And Oliver Hart really very nicely set us up by making the case for a greater role for shareholder democracy in corporate governance. And in this session, we're going to first hear a presentation from Jonathon Zytnick, who's an associate professor at the Georgetown University School of Law. And he's not just an academic, actually, because he has also acted as counsel to an SEC commissioner, as well as having had a spell in practice. And Jonathon's paper is going to kind of look at the question of whether mutual funds do, as a matter of fact, represent their end investors, or do we actually have a disconnect and a problem that needs to be solved? And once Jonathon has completed that presentation for about 15, 20 minutes, we're then going to have a panel discussion, and actually I'll introduce our esteemed panel more fully at the point we start the discussion. So for now, let's go over to Jonathon, and thank you very much.
Can everyone hear me? In the back? Excellent. Thank you, Tom, for the introduction. I'm John Zytnick. I'm an associate professor at Georgetown Law School, and I'll be presenting Do Mutual Funds Represent Individual Investors? And I want to thank the organizers for having me, Marco for inviting me, and all of you for being here. I feel very fortunate to be presenting after Oliver Hart, because his work with Luigi Zingales over the past few years does so much of the work in motivating this paper. So if you don't mind, I'll take a minute to talk about their work before I talk about mine. So companies are run for the benefit of human beings, and human beings have heterogeneous non-financial welfare interests. So Hart and Zingales say that we should maximize shareholder welfare and not share value. So they've transformed a conceptual problem into a measurement problem. So how do you know what maximizes shareholder welfare? Well, they have one proposal, which is to ask the shareholders, conduct a vote, aggregate the preferences. So this is where my research comes in. Of course, a shareholder vote is not going to be a perfect measure of the preferences of human beings. And in fact, one way to look at my paper is it's about the gaps between what a shareholder vote produces and what people want. And two gaps in particular. One is the fact that most individual investors who own stocks directly don't vote. And the other is the fact that most individuals are exposed to stocks indirectly through their ownership of institutional investors who cast votes on their behalf. Today, just to fair warning, today we've seen a bunch of extremely distinguished people give proposals on how to save the world. And now we're going to watch something more fascinating, which is a very careful measurement of an empirical question. So, strap in. All right, so mutual funds. Mutual funds own, or institutional investors own most of the shares of most public companies. And institutional investors vote. So as shareholders, they set the direction for public companies. So a question that a lot of people ask is, how do mutual funds vote? What choices do they make? And there's a whole literature. And one theme that really comes out of this literature is that mutual funds vote differently from each other. They clump together into consistent ideological parties. Okay, so that's mutual funds. And then Patrick Bolton, who we saw earlier, dear friend, one of my PhD advisors, he asked, well, what about individual investors? Do they even know that mutual funds have these different voting preferences? Do the voting preferences come from individual investors? And that's what this paper is about. So we can think of it as having two parts. In the first part, I'm looking at individual investors. I'm saying, what can we say about their preferences, including the preferences of non-voters? And then in the second part, I'm asking the titular question of the paper, which is, do mutual funds represent individual investors? So I'm going to be looking at how individual investors vote, what their preferences are, and I'm going to be looking at the specific mutual funds that they own. So why should we care if mutual funds represent individual investors? There's a quote that I open up the paper with from the Bloomberg columnist, Matt Levine, who's taken to calling institutional investors a second government. And it's this idea that the paper is exploring. So the power of institutional investors to vote comes from their individuals who put money into the fund. And so to what extent does this look like representative democracy? So we can think of this as an economics question. So there's lots of variation in how funds vote. To what extent is this consumer driven? And we can think of this as a policy question. So the SEC in the US has made a strong push and is continuing to make a strong push for a strong marketplace for investor ideology. So we can look at whether that's worked and what the factors are. And I think the paper is about both of these things. But it's also about a question in political science that for US political bodies we have 70 years of empirical research on, which is the question of representativeness. So one of the major long-standing findings in political science is that elected political bodies are largely representative of their constituents. So a US congressperson from California votes differently than a congressperson from Wyoming. And those differences are correlated with the preferences of their underlying constituents. It's hard to say much about congressional voting without knowing that fact. Now, this is a different question, of course, from should institutional investors represent their underlying constituents. That's a tough question, but it turns out just answering the descriptive question is also very hard, so that's going to be my focus for today. Okay, so in the rest of this presentation, the rest of our time together, I'm going to talk about sample selection bias, which is the big empirical concern here. What can we learn about non-voter preferences from voter preferences? I'm going to briefly talk about aspects of individual investor ideology that are important to this project, although I might skip those things. And then I'll talk about representativeness. Do mutual funds, does the variation in mutual fund voting reflect the variation in individual investor voting? All right, so let me talk about how I do the empirical research for this. My data come from Broadridge, which is the service provider that handles shareholder voting for virtually all US brokers. They've provided me a couple data sets. One is individual investor ownership and votes for shareholder meetings for the years 2015 through 2017. So by the way, the data here is a little bit old. Things might have changed in the past few years, but we do the best we can with what we have. So shareholder meetings from 2015 through 2017. And then the second data set, which is new to this project, is the same thing, but for mutual fund meetings. So mutual funds have shareholder meetings, sometimes. Closed-end funds have them every year, like regular operating companies, and open-end funds have them intermittently for certain business. Now, I don't care for this project about mutual fund shareholder meetings. What they give me is a snapshot of who owns the fund as of the record date of the meeting. Now, it's not a perfect snapshot because not every mutual fund has a shareholder meeting in the 3-year span of my data. So in total, I've got about 1/3 of open-end mutual funds at some point in my data, about half by dollar value, plus I have all the closed-end funds. So these are funds for whom I can see who owns them during my sample period. All right, so let me introduce a new fact. So here I'm just looking at a simple aggregate comparison of how individual investors vote versus how mutual funds vote. Now, this is at the voter level. So I aggregate up each voter's votes, and then I take the average of individuals, and I take the average of mutual funds. And new fact is individual investors and mutual funds actually vote pretty similarly in the aggregate on a category basis. So social responsibility, environmental and social proposals, they're pretty similar. Management proposals, they're pretty similar. Governance proposals, mutual funds are much more in favor of governance proposals. All right, so this is a good time to pause and talk about sample selection bias, which is the main empirical concern with the paper. So there's a few places that sample selection bias might creep in. But the one we're really worried about is that most individual investors don't vote. And I'm using the votes of voters to say something about the preferences of individual investors as a whole. So what can we learn about individual investors as a whole from the votes of voters? Now, I have a few different methods. And by the way, I'm going into the weeds here for a very important reason, which is I want people to see how hard I've worked. Okay, so I use multiple approaches to dealing with sample selection bias. And one that I'm going to show you later, as a measure of people's ideology, instead of using their votes, I use the political lean of their zip code. So the idea is I can see everybody's zip code. Not everybody votes, but everybody's got a zip code in my data. So that gets rid of the sample selection bias. It's a noisy measure of ideology, but I show that using it you can get broadly similar results. So that's later. But first, I want to show you a different method, which uses the tools of the identification revolution in economics to correct for sample selection bias. And the idea is you need something that provides exogenous variation in whether or not you're a voter without being related to your voting preferences. So let me walk through it a bit. What I want is the average investor ideology. So we can take the average vote of voters, but the concern here is that the average vote of voters might be different from what the average vote of non-voters might be. And in particular, what we're worried about is there might be something, let's just say the size of your portfolio. There might be something that is related to both whether or not you choose to vote and also your ideology as far as how to vote. And that would create sample selection bias. Now, when we're talking about sample selection bias, we have to divide it into two types. There's selection on observable variables and selection on unobservable variables. Now, selection on observable variables, that would be like in the example I gave, if the size of your portfolio is connected to both your decision to vote and also how you vote, well then I can actually correct for that pretty easily. Similar, for those of you who know a bit of econometrics, similar to controlling for things in a linear regression. The method is different, but the concept is similar. But then there's sample selection on unobservable variables. These are things where I can't see why you're turning out or not turning out. And this is very similar to the concept of omitted variable bias in economics. Now, the way to deal with selection on unobservable variables is you need something called an excluded variable. And the excluded variable is something that has to be related to your probability of being in the sample, of being a voter, without being related to the thing you're trying to measure, in this case, how you vote. So I have such a variable. So it turns out that firms in the US can choose whether individual investors receive a mail ballot or not, a ballot to cast their vote by mail. And that makes a big difference in whether you turn out. So I'll quickly just run through it here. So in this graph, on the y-axis, we've got your change in turnout compared to 2015. And it's compared to some control groups as well. And in the blue dots, these are people who did not have a mail ballot. And then in 2017, their firm switches them from not having a mail ballot to having a mail ballot. And we can see their turnout jumps. And in the red, the same thing. These are people who had a mail ballot in 2015. And then in 2016, you see there's no change. And then in 2017, their firm takes away the mail ballot from them. And you can see their turnout drops. So having a ballot to vote by mail makes a big difference in whether or not you turn out. Now, when you're dealing with an excluded variable, there's two requirements for it to be a good excluded variable. And one is called the relevance condition, which means that it has to be related to, in this case, related to being your probability of being a voter. So that's what I showed you in the previous slide. And then the second condition is the exclusion restriction. And what this says is it must be unrelated to your voting choices. So let me walk through a little bit of intuition for how this works. So the excluded variable shifts your probability of being in the sample, but it doesn't directly affect your ideology. So any resulting variation in your ideology has to be a consequence of the shift in turnout. So I'll just kind of walk through a little illustration. So on the x-axis here, we've got the excluded variable, and then the blue line is your probability of turning out. And we can see that the excluded variable is correlated with your probability of turning out. That's the first condition. That's the relevance condition. Now, we have assumed, let's assume that the exclusion restriction holds true. So there's no relationship between the excluded variable and how you vote. And let's say we observe that there's a positive slope between how you actually vote and the excluded variable. Now, because of the assumption that I made, this positive slope that we see here on the red line must be due to selection. It must be due to a selection effect. So this allows me to correct for the slope of the red line and correct for sample selection bias. All right, so that's the idea. Now, there's a rule with exclusion restrictions, which is they cannot be empirically tested. So they're an assumption based on institutional knowledge. So here the assumption is that getting a mail ballot or not getting a mail ballot shouldn't change how you feel about any given proposal. It should only change whether or not you vote. I do want to say that in this particular case, I can actually provide some empirical evidence in support of the exclusion restriction using some placebo groups that aren't affected. But I'm happy to talk offline about that. I won't go into it here. All right, so let's jump to the results on sample selection bias. So in the left column here, we see just your agreement rate with management. This is a simple average, and there's about a 12% disagreement rate. And then in the middle column, I correct for selection on observables using inverse probability weighting. Again, I'm just using that phrase to show you how hard I'm working. And you can see that selection on observables does not change the result much. There's about, it looks like 13.1% disagreement with management. And then in the final column, I use both inverse probability weighting and the excluded variable to correct for selection on observables and unobservables. And we can see, again, the numbers don't change very much. So this shows that the votes of voters do a pretty good job of representing the votes of non-voters. Now, there's some questions about how exactly to interpret the results here, because it's based on people who are driven from not voting to voting by the presence of a mail ballot. But that's the general idea for how to correct for the sample selection bias in this case. All right, so a couple things for the rest of the paper. So there I was showing results just on all proposals. The paper's in transition. In the future, I'm going to be switching to just social responsibility proposals. Everything you see from here on out is just social responsibility proposals. Also, a nice thing about the method that I just showed you is you can correct for sample selection bias for each individual observation, for each individual voter. I just haven't carried that through for the rest of the paper. So again, paper's in transition, but everything you see from here on out is just going to be raw numbers. I think I'll skip over this slide for time, but a couple of points I want to make from it. So individual investors are very ideological. They tend to vote consistently and predictably on a range of issues. And in particular, you've got some individual investors who consistently vote against social responsibility proposals, environmental, social proposals, and you've got other individual investors who vote consistently for them. They're in fact more extreme in this regard than mutual funds, which are also quite ideological. All right, so now we can jump to the main result, which is do mutual funds represent individual investors? So let me show you a scatter plot. So each dot here represents a mutual fund. And on the y-axis, I've got how the fund votes on SRI proposals. And on the x-axis, I've got the average of the fund's investors, average for each fund. So let me repeat that. On the y-axis, I've got how the fund votes on SRI proposals. And on the x-axis, for each fund, I take the average of their individual investors' votes. All right, and for everyone's convenience, I've separated out ESG funds, explicitly labeled ESG funds. I've made those red triangles. So a couple of things that I want to point out about this graph. So first, looking at the y-axis, we see there's a lot of variation in how funds vote. So just a big range of voting choices on the y-axis. And then on the x-axis, focusing for just a moment on the blue dots, ignoring the red triangles for a moment, we see there's not much variation in how the individual investors at each fund aggregate together. So to be clear, individual investors have a wide range in how they vote, but they aggregate into each fund in the same way. We see all the funds are in a narrow band on the x-axis. And even to the extent there are funds that, even to the extent there is variation on the x-axis, it's completely uncorrelated with the variation on the y-axis. There's no slope here. So one conclusion is that there is no real marketplace for investor ideology. The funds that are voting pro-SRI and the funds that are voting anti-SRI have the exact same shareholder base. Now, there's an important exception to all this, which is the red triangles, explicitly labeled ESG funds. So these funds are high up on the graph, so they vote pro-SRI. And they've also got really pro-SRI shareholders. So if you want an answer to the question of do mutual funds represent individual investors, the answer is it kind of depends. If you were to run a regression here, you would get strongly significant results, actually. But it's entirely driven by the ESG funds. If you were to value weight rather than weighting each fund equally, then you'd get no result because the ESG funds are pretty small. Or if you were to just control for ESG funds, then you would get no result. So the yes or no answer is it's actually a bit mixed. Now, I said that I would show another method of dealing with sample selection bias. So here it is. So this is the same graph as before. So we've got the fund's votes on the y-axis. But on the x-axis now, rather than using an individual investor's votes, I use, for their zip code, the percentage voting for Hillary Clinton in 2016. And I average that together for each fund. Now, this is, of course, a very noisy measure of an individual's ideology. It's how a bunch of people, including them perhaps, voted in a completely different setting. But it is strongly correlated with how you vote in shareholder votes. And we can see that the results look broadly similar, although squished. So this is pretty broadly supporting the idea, the notion that even if you're looking at non-voters as a whole, ESG funds are driving 100% of the representativeness between mutual fund voting and individual investor voting. All right, so now we're done with the results. Just a couple of last things. So in the paper, I try to look at why we don't see representativeness, because it's clear that individual investors seem to care a lot about environmental and social proposals in one direction or another. They have strong opinions, they vote consistently. So it's surprising that people who vote 100% against SRI would buy funds that do the opposite, and vice versa. It's surprising that we don't see any patterns there. And so I find some evidence that I won't show here in favor of perhaps it being at least partially driven by limited attention, the fact that people don't really know how funds vote and it's kind of hard to figure it out. I want to talk a little bit about current trends, although the downside of going after Oliver Hart is he already discussed these. So we're seeing signs, perhaps, that there's more representativeness than before, and two ways in particular. First, we're seeing explicitly ideological funds start. You know, the blue fund or the red fund, and I guess they're trying to take a share of the market. And then with big established funds, we're seeing much more, variations on pass-through voting, whether they're polling customers or asking customers' opinions, or in the case of BlackRock, letting their institutional investors have complete pass-through voting. So if we were to extend the data out to today, we might see a shift towards perhaps a bit of representativeness. All right, I think I will wrap up there, and I'm really looking forward to the panel discussion.
Thank you very much, Jonathan, for an absolutely fascinating presentation. And to discuss that now, we've got a great panel. Starting on my right, we've got Bart De Smet, who's the chair of Aegis and also of the Federation of Belgian Enterprises. Thank you very much for joining us. Lieve Mostrey, who's the CEO of Euroclear, who is one of Europe's major markets infrastructure, financial markets infrastructure providers, and Carine Smith Ihenacho, who is the Chief Governance and Compliance Officer at Norges Bank Investment Management. So you're all extremely welcome. And I'm going to facilitate some discussion amongst the panel, but there should be time at the end for questions from the audience as well. So please do use Slido as before, or prepare your questions for later. Now, I'm going to come on to the implications of some of what Jonathon has presented, and actually also Oliver before him. But before that, I wanted to sort of take a step back, because I mean, one of the reasons why this whole question of representativeness is considered to be important is that there's this sort of expectation that investor stewardship on major social issues like climate change can actually make a big difference to what companies do, and can therefore make a big difference to solving some of these social problems. So the first thing I'd like to explore is how realistic that really is. And perhaps, Lieve, I could come to you first, and then Bart to you. Does investor engagement with companies on climate change, does it actually help, hinder, or make no difference to companies' efforts on climate change? And from your experience, what works well and not so well? So Lieve, perhaps could start with you.
So thank you, Tom, for that question. Maybe first, just shortly, briefly, position ourselves as a market infrastructure. So we operate between issuers and investors across the globe. We safekeep their securities, we settle their transactions, we mobilize their assets for collateral management purposes. And with that, we hold on our books about 36 trillion euros worth of securities. And we transact on a yearly basis about 1 quadrillion. For those that are not mathematicians, that's a 1 and 15 zeros worth of euros of transactions on our books. So we are not the investor side, we are not the issuer side, but as a market infrastructure, I believe that we have a role as an observer to see what's happening in the ecosystem. So first of all, I would join the message that Patrick Bolton gave this morning on saying investors and financial markets cannot substitute for government. And if you think on what is working a lot, it is clearly everything that has to do with regulation around climate change, around expectation of financial actors around this. And so this is a major contribution. But if we look at what is happening on our platform, I see 3 symptoms that indicate that this is really helping and contributing. The first symptom that I would mention is what happens when we see the issuance, be that by a government, be that by a supranational or by a company, of green bonds. We clearly see that the oversubscription in such cases is so huge, the demand is so huge, that the label of being ESG, being a green bond, being defined as such, is very important and really moves the dials towards investors. So that is a first symptom we observe, and where I say this is clearly supporting the idea that it does matter. A second one is when we engage with issuers, we get a very clear message from them. Not so long ago, I spoke to the chairperson of the European Issuers Federation, who really is asking for help. Help us as an issuer to demonstrate our credentials in the ESG space. Help us how we can then use those to score ourselves against taxonomy so that we can remain relevant, both as an issuer and also when discussing credits with financial institutions. So that is a second symptom that I would say that is clearly supporting the relevance of all what we are talking about. Another one that I would put in that category is also when we discuss with emerging markets. Euroclear has a long experience of connecting emerging markets towards the international investors, and that has helped those emerging markets to attract more direct foreign investment on the one hand, at a lower cost at the other hand. And so what we observe now is that the same emerging markets say, we need help for us to be able to issue ESG bonds, green bonds, because if we cannot do that, the problems we had solved by becoming Euroclearable and attracting investors are popping up again. Because we cannot compete and not be sufficiently attractive if we cannot demonstrate or compliance with taxonomies or attractiveness from the ESG angle. So what I observed there is clearly an indication that all what we are talking about really does matter. Also, when we engage with investors, be that directly the buy side, or be that through their intermediaries, the custodians, the questions about more and more transparency, not only at issuance, not only at IPO, but also in the course of the life of a security, becomes more and more important. And as a market infrastructure, this is a bit comparable to what we used to do always when managing corporate actions for companies. So this is where we see a role for ourselves in that space.
Thanks very much. So, I mean, clearly you're seeing the financial flows, you know, kind of marry up to many of these considerations. And I mean, Bart, perhaps if I could come to you, I mean, as an issuer, I mean, I guess you've got two hats in this year, as an issuer and also as an investor. But I guess in your engagement with your own investors, do you find that engagement kind of helps your climate action? Is it a distraction? Is it effective? What does and doesn't work well?
Well, let's say, first of all, I'm sitting here more as chairman of the Federation of Belgian Enterprises. Our CEO, Hans De Kuiper, has given a very good presentation. I read it. I was not here this morning, so I'll try to broaden it a bit and to talk more to the corporate world, you know, as a whole. And what I see is that many corporates really increasingly focus their attention on the wider impact of climate change, and this is a consequence of increased awareness that's pushed from inside, employees, the boards, but also from outside, and there you have investors, of course, although I must say my experience, and I'm now almost 2 years not in weekly or monthly interaction with analysts and investors anymore. That's now Hans' job to do. But in the 10, 12 years that I have met maybe in roadshows, 150 to 200 firms, I almost never received questions on what you could call the ESG issues. It was about buybacks, dividends, about the little elements they needed to adjust their spreadsheets. But what we see is that there is a sharp increase in the last 2 years in that area. And so the main attention point for me is that we have to be careful that corporates, and I really see a high commitment to contribute as much as possible to this change, but that we give them sufficient time to really go for the transition. We do not see it as black and white, you're good or you're bad. And that's where I'm a bit afraid that on one side over-regulation is necessary, but over-regulation on the one side and activism on the other side could distract management and boards from doing the things they believe they should do. And so it's without any doubt that investors are pushing more, but not at that level that they are the drivers of change. I see it much more just naturally by the board, by management, by people in the company, which is a very good evolution. That it's not a push, but a conviction that we have to change.
And you're not seeing an impediment from investor engagement. It sounds like you're seeing it as a modest additional.
Well, let's say, being a bit cynical, as long as you have the good and the nice returns, they will not react. But if tomorrow, it's a bit same with consumers. We are all convinced that things have to change, but please don't at a higher cost. And that's sometimes, we cannot over generalize, but that's sometimes what I felt in discussions with investors, that they are okay as long as the returns are the ones they would have in the, non-SRE environment.
And actually, I'll come back to you on that question in a moment, actually. It's something I wanted to pursue. But first, maybe, Carine, if you could give the sort of investor perspective on this. I mean, Norges Bank Investment Management has just published a climate action plan, which has sort of articulated what you see your role as being in helping drive the transition. Perhaps you could explain that.
Yeah, that's correct. I mean, we have worked on climate change risk for many, many years, but we now will step up the work, and we have then published a climate action plan to really set out what we are going to do. It's detailed and it's ambitious. And I think at the core of the plan is really 3 main points. One is that it's a clear net zero goal in 2050 for the companies in the portfolio, science-based goals. Number 2 is that we have this engage for change approach, so really that we want to be an active owner and push the companies, be much more active towards many more companies. And 3 is that we'll report more, both on the climate risk we're facing as a fund, but also the results of our activities. Then you asked earlier, can we have an impact? Will it work? Will it make any difference? The way we will engage with the companies is through having dialogue, company meetings, and through voting. That's really the sort of main tools. And some people ask, you go to meetings, you say blah, 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 and companies say blah, blah, blah. Does it really have an impact? We actually think it will. What we've seen, when we measured early engagement, is that what we do actually have an impact on the companies we have engaged with, that they change more than the companies we don't engage with. But having said that, I think we need to also be very realistic, and Lieve mentioned that, we can't step in and solve everything that lack of regulations is not solving when it comes to the climate. But we do think it will have an impact, and the great thing is that we report extensively on what we do and the outcomes of that, so you can all follow us and see if you're doing a good job or not.
Mm-hmm. Yeah, and I mean, this point about what's realistic in the absence of sort of robust regulation and economic incentives, I'd like to come on to that, and Bart, it picks up, I think, on where you finished your previous comments, in that, it does strike me that, companies and indeed investors face conflicting pressures, because there's one group of people who are saying, we've got to do 1.5 degrees, we're limited or no overshoot, we've really got to, be aggressive about tackling global warming. But on the other hand, society as a whole across the world is sort of meandering drunkenly towards, 2 degrees or a little bit more. And so actually course correcting onto 1.5 could be costly for companies and investors. And so how do you manage that tension about how fast you go? How do businesses do that? How fast they go, whilst recognizing that there's a reality of what the economic incentives are pointing to today? How do firms manage that conflict?
Well, maybe I start by giving an example that is a bad example. I recently heard somebody speaking very proudly about the fact that they had sold part of their group because it was polluting, and they even made a capital gain on the sales. But then what happens, the party that buys it just continues with the polluting firm. So that's not the way I think you should go. And if you look to the impact, and I now look to Europe, Europe is responsible for something like 7% of CO2 emissions, and a number of people say, the others are not following the same way. And I also personally, having been a week in May in Davos, I was really surprised, negatively surprised by the lack of, and Lieve was there too, the lack of urgency I felt from the US people in Davos. So it's really Europe that is, again, and there's nothing wrong with that, leading the change in this area. And so a lot of people say, yeah, but they don't follow, the Africans will not do the same thing. What is China going to do? So why do we do all this? And that's the wrong approach, because I'm sure that if you look in the long term, it's without any doubt that sustainable businesses will survive, will be more profitable than the ones that are not sustainable. So it's a matter of having this transition in a controlled way, so that you still are alive when you should be alive, and that on the other way you build that resilient business that is sustainable, and where for me, let's say profitability and sustainability is not at all a contradiction.
Yeah, I mean, and Carine, I'd maybe like to come to you about how you think about that from the investment perspective, because I do understand how over the long term there may not be a contradiction, but actually there must be a contradiction at some point around pace of change. So if you were genuinely investing, for example, towards 1.5 degrees, you might be buying coal assets and just shutting them down, right? As opposed to, as you say, selling them on to someone who might operate them in a less scrutinized environment. So how, as an investor, do you think about this trade-off between your fiduciary duty to your beneficiaries and this kind of need to address the climate crisis?
Yeah, I'm looking at Professor Hart here because he knows what I had planned to say, and there's no contradiction because you said every investor say that if you are a long-term investor, it all goes hand in hand. But then you also said that's not true. There are some trades-off, and for sure there is. Absolutely, as an investor, there are trade-offs, short-term trade-offs. I do think in the longer terms, the trade-offs are less when it comes to pushing on reducing emissions, but certainly in the shorter term there are. What we've done is that we have really been very transparent on our expectations to the companies. We publish that expectation documents, so we really see this is what we expect. And engage with them. And it's not that and there we are clear that, transition can take time. It will take time, but it's the 2050 goal we're sort of mostly looking for, although we ask large emitters to start, reducing now. But I think as a long-term investor, we are prepared to take some of those trade-offs because it's also in our mandate to be a responsible investor. It's also in our mandate to work towards the companies going towards net zero in 2050. So I think that's part of that is to prepare to take some trade-offs on it.
Okay, well, no, thanks for being upfront about that. And so now maybe if I could come to you, Lieve, how do you see this tension between the pressure from some stakeholder groups to really drive hard on the transition versus commercial realities for business?
So for our company, we have integrated sustainability, both in the purpose of us as a financial market infrastructure and what we bring to the market actors, and we have also integrated in our strategy. So if we think about the sustainability agenda for Euroclear, we see it on two fronts. First of all, we see it as a market infrastructure to help the ecosystem to become more efficient, to operate at scale, and to operate with harmonized standards in this space as well, just as we do it in other business. But also as a company, we have the objective to be very active in the ESG space. We are carbon neutral since 2012, and we have subscribed to the net zero commitment based on the scientific targets by 2050. We have our chief sustainability officer that is not only looking at the climate environment, because unlike other financial institutions, we don't have a credit book, so we could say that for us it's a bit easier than for many others. But we also look at the social aspects of the ESG agenda, the governance aspect. Governance aspects also play a role, not only for us as a company, but also in where we can help issuers in their governance challenges, in their transparency with their ultimate shareholders. So these are the dimensions we are looking at. So far, I must say, we are not a listed company, we are a privately held company, but we have our shareholders that support that purpose and that strategy and do not observe any contradiction between the normal course of our business and these goals.
Okay, thank you. Thank you. I'd like to now bring us back to Jonathon's work and the presentation that he gave. And because, one route through this sort of fiduciary duty question is to get really clear on what shareholders want and then kind of act in alignment with that. But there is now this concern that actually, amongst some people, in some ways, investor action isn't always aligned with what the end investors actually want them to do. And Jonathon's research suggests that is a problem. So I'd like to ask the panelists, and then I'll ask Jonathon for his reflections on the discussion. do you think we have a problem at the moment with a lack of legitimacy of investor action on environmental and social issues? Because there is this kind of point of view that actually, this is just, big investors who are just wanting to burnish their credentials for asset gathering purposes are doing a bunch of stuff or forcing companies to do a bunch of stuff that actually the underlying investors don't actually want to happen, that this is a crisis of legitimacy in shareholder democracy. And I think Jonathon's research provides a little bit of succor to that point of view. And Carine, perhaps starting with you, do you think there's a problem here, and how do you as an investor ensure that you're reflecting the views of your beneficiaries in how you act on these issues?
Okay, so we are a sovereign wealth fund, so our beneficiaries is 5 million Norwegian people, but I must say not just those living today, but also future generations, because we are a generational fund in many ways. And we get our investment mandate from the Ministry of Finance. And I think we have quite a good process for checking in actually to the beneficiary, because every year we report extensively on our responsible investment work and on the voting we've done. And then every year the ministry writes a long it's a white paper going to the parliament. It gets discussed in the finance committee. It's input from civil society. It's big debates in the parliament representing all the beneficiaries. And then there's the mandate may or may not be changed. We also have guidelines for ethical exclusions that's updated on a general basis that really sets out companies or reasons for excluding companies either based on conduct or products, and they get updated on a regular basis, and we have big processes for that also. So I think with this sort of transparent process, we have the getting views from all of us, debating. It sort of gives the work we do, I think, legitimacy and make sure that our beneficiaries are being heard. And I think what we also strive for is really being transparent. For instance, on the voting, and maybe you won't know that, but we always put our votes out 5 days before the shareholder meeting, so that everybody can see how we intend to vote. And then if there's some debate around that, we can also take that up front in many ways. So all votes are now put out with a rationale, where we vote against the management 5 days before the meeting. So I think we probably have a quite special structure being a sovereign wealth fund. But I think there's at least some takeaways. It's really to be transparent on the work, the intentions behind the work, and sort of the outcomes, and try to check in somehow with the beneficiaries.
Yeah, you have actually got a process for trying to elicit those views, haven't you, from beneficiaries? And so, Lieve, perhaps I could come to you looking at it from your perspective. Do you think we've got a problem with legitimacy? Would it improve matters if somehow end investors had a bigger say in what intermediaries do, or would it just create chaos for you to have that?
I would give a first observation. As Euroclear, we are also a very special case in point, as we are not listed. We are a private company, and we have quite some shareholder representatives also on the board, next to independent board members, next to executive board members, and also a user representative. But the overall percentage of shareholding that is represented on our board is around 50%. So I would say from taking the point of view and checking with what the shareholders want and expect from the company and from management, there is a natural and permanent process, I would say. On the infrastructure side, I would say two things where we help the market in a number of ways. First of all, we help issuers to have true investor insights, really an exhaustive repository of their shareholders so that they can know and they can have the reach out and they can have the engagement to the extent they want that. And with the Shareholders' Right Directive that is now active in Europe, this has a lot of pickup by issuers, and this is a well appreciated product. And so then there is also obviously the whole practices around proxy voting. You mentioned that you worked with Broadridge. You know them very well. My only observation that I would do, and maybe I'm shocking a bit some others around the table, but if I think about a proposal of going back on a very regular basis to shareholders to check their approval or disapproval, I would say it's not a technological problem to do so, but I do see a management problem on how you can continue to manage efficiently your company, how you can be agile enough, because a lot of things are happening in your ecosystem and you have to react, and it is not always obvious to do that step. So that would be my personal observation on that last dimension.
Yeah, I mean, Bart, I saw you doing some nodding at the end there, and I'm wondering how how your members in the Federation of Belgian Enterprises would feel about this sort of greater role for ultimate shareholder democracy. Would you welcome it, or do you have concerns?
Well, let's say, first of all, I'm of the opinion that you need good regulation, you need good corporate governance codes, but even more important is that you have strong and ethically strong management and board members, because you can have the best legislation, best code, and we still see from time to time scandals popping up, and it's mostly linked to people that are not willing to respect these things. With respect to involvement of all stakeholders, I believe Hans has given a nice presentation about how he's doing that within ECGI. We also have seen that in a materiality assessment that we've made with all stakeholders, that the first thing all stakeholders want, also employees, also consumers and unions, is a financial strong resilience of the company they are investing in. And that is not, again, in contradiction with guiding or having a strategy that is really sustainable for the future and looking forward to contribute to a better world. And with respect to involvement, for instance, there are people provoking that you should put maybe a representative of clients in your board. The question is always, who is a representative client for the millions of clients we've got? There are other ways to involve them, to take care of their wishes and their impediments. What you see is that most of people you talk to are in favor of a more sustainable life. And the question is, like also what I see with governments, there's a huge gap between what is said people would like and what they actually do. And it's also because it's not easy. It's about costs, it's about changes to make, another way of living. And so I don't think that you get forward by asking them what you have to ask what they want, but you have, as a company, as a corporate, to decide yourself what route you want to go by taking into account the, let's say, the expectations of all stakeholders. And if I look to the Federation of Belgian Enterprises, I believe that in Belgium, like in Europe, we are much more convinced about the way forward than what I see in other continents in the world. We have, for instance, the tagline is creating values for society, which is something that was unacceptable for the Federation of Belgian Enterprises 10 years ago. But now it's part. There is a huge effort on, for instance, the whole circular economy and so on, where Belgium is one of the leaders in Europe. So there is a lot to be done, and you can involve all your stakeholders, but you have to be, let's say, strong and firm enough to decide what you believe is best for society.
I mean, I think there's a really interesting kind of philosophical contrast opening up here between, you know, the company that is kind of responsive to its shareholders and their directions and what they want it to do, and actually the company that decides what it wants to do and then in a way, the shareholders either decide whether they want to be part of that or not. I mean, there are various points on the spectrum we could sit. And Jonathon, I'd like to bring you in here now for your reflections on the discussion we've had so far. And actually, also, I'd like to push you a little bit because you were very careful to remain kind of neutral and empirical in your description of your research. But I would like to ask you whether having done all of that, you feel there's a real problem here with legitimacy, that there's a real kind of fundamental mismatch, and actually whether you think it would be a good thing if we got better alignment. So I'm going to ask you to be a bit more normative in your comments.
Yeah, so when you write a paper called "Do Mutual Funds Represent Individual Investors?", people sometimes ask you, should mutual funds represent individual investors?
That's the risk you run. Right?
Yeah, I think there's a case to be made for representativeness in a pretty narrow band of things, and it's actually kind of the band that we're talking about. This is really I'm giving a hard and Zingales answer here, but certainly I don't think mutual funds should pay attention to individual investor preferences on director elections or amending the omnibus incentive plan, because there's just going to be too much of an information gap. So when we think about what does voting give you, why do we vote at all? There's really two reasons. One is information aggregation, collecting information from people, and individual investors probably don't have too much information to provide. And then the other reason is preference aggregation. People have different preferences. So these are the two reasons why we might vote on political candidates. In the context of shareholder voting, what that really means is I think that funds should pay some fidelity to individual investors on questions of the purpose of the corporation. This is exactly the Hard and Zingales idea. When there's differences of opinion as to, should the fund maximize profits, should the fund shut down its factory to help the environment, that does feel like a legitimate question that individual investors have different preferences on, and so funds should, in an ideal world, be aware of those preferences and channel them.
Okay. Yeah, and I mean, I guess the question then becomes how to do that in a manageable way. And in the last few sessions, we've had a few ideas that have been thrown out there, right? So, I mean, some are, we could ask fund managers and asset owners to do a little bit more research on their client and beneficiary preferences, and that's sort of the approach that you described, Carine. I mean, we've heard today about BlackRock sort of disintermediating themselves from the voting process and letting end clients just do that on their behalf. Oliver talked about potential mutual funds with different stances, or even, you could have different proxy voting agencies representing different political views. And Jonathon, in your own work, you expressed almost some surprise that actually funds haven't sorted a little bit more into different approaches. And I'm just perhaps starting with Bart, and this relates a little bit to your last answer, but from a corporate point of view, there is a risk that any of these approaches become a bit chaotic to manage, and so what do you think a practical route could be to getting more of that end shareholder voice in a way that was actually manageable for companies?
Well, a first point is always to stay sufficiently close to your investors, be it institutionals of retail. Again, and some of you in the room will remember what the group where Aegeas has been grown out has experienced in the financial crisis. After the restart, we have decided not only to go in let's say regular meetings with let's say analysts and institutional investors that are a good reference to see whether we are on the right road, but also to create a club with thousands of retail shareholders that we meet regularly, where we give them information, where we receive a lot of response. And I would say this is something that is of high value. On the other hand, you can go very, very far in giving information and so on, and I think the bankers in the room will know it. At the end, it becomes such a burden of information that people just don't look at it anymore. So the question is also with MiFID, which is always the principle is very good. The question is whether the execution on the ground is not so over complex that it completely misses its initial goal, that people are not are just counting on their salesperson to say, okay, I trust this person, so I buy it. There's also the question of should you not segment more funds and make them more specific. Again, you can do that, but the more you segment, the more you will have need of capable people. Your cost will go down. It will have an impact on the returns. And there I sometimes am surprised that people in the shorter term, when they say we really deliberately want to go for social responsible investments, but if at the end of the year there is a 0.5% difference being lower in return, it seems to be unacceptable. It's a bit what happened with one of the front runners in the change in doing business, Faber with Danone, where at the end he has been dismissed because the returns were below what some shareholders expected. So I think it's complex, and if we believe that the whole change can be made without any efforts, be it financially, be it in another way of consumption, and now in the energy crisis we have another nice example, it will not happen.
And Lieve, I'd love to get your perspectives on this as well. And I mean, in your previous answer, you sort of indicated that actually this isn't really a technology problem. The technology can be solved. It's more of a kind of an information management problem for the end users. So I'm sort of hearing that you're a little bit skeptical about the benefits of this greater democratization.
Well, I think it has to remain, it's all a question about granularity. And if you go extremely granular on these principles, we should not forget that you have then several companies that sit with several mutual funds, and the shareholders behind those mutual funds change all of the time. So if you go extremely granular, this becomes very hard to manage, and especially also from the company's perspective. So I do believe that we have to integrate in the debate also probably a greater requirement towards companies on transparency around purpose, around strategy, which in my view would then translate in a clear mandate from the shareholder, and which would then make less requirements to have these regular checks of what a shareholder wants or not, and would make it much less granular. So I could see such a question on the purpose, on a multi-year strategic plan. That makes a lot of sense, but not too granular.
Yeah, and again, what's really interesting about that is you're almost presenting that as a company setting out its stall, and then the investors decide whether they want to go along with that, rather than the company going out and saying to all of the investors, what do you think our purpose should be, and sort of cobbling something together from that. So that's very interesting. Carine, I'd like to just pick up on a particular aspect of some of these democratization proposals with you, because some of them worry me a little bit, like, for example, the BlackRock voting choice, which is that, you know, if you look at the evidence on effective engagement, I mean, it does seem to me that there's a combination between voting, engagement, and actually owning the shares and therefore having that understanding, and also therefore having the threat of exit. And to what extent do you think we can just unbundle this stuff and have, you know, disintermediated voting from engagement and ownership? Is that going to work, or are there problems with that?
Yeah, I mean, we see voting very much as one of a couple of tools we have as an investor, right? So we see engagement and voting very closely linked, because voting is a great tool in the sense that for us, an investor in 9,000 companies, you reach all the companies in the portfolio at least once a year. And it can be a great signal how you vote, even though maybe your vote doesn't get a majority vote. At least it sends a signal, this is what we as an investor like. But for the companies that we meet more regularly, let's say the 800 to 1,000 biggest companies in the portfolio, we very much see it as linked. You have a dialogue, let's say now with the climate action plans, for instance. We'll talk to the company, say these are our expectations, But after a while, if nothing happens, then we can start to vote against the board and hold the board, we call it hold the board accountable, right? Voting against the board. But the whole process you talked about making it more democratic. Just talk a little bit about the voting process for large institutional investor. It is complicated, right? Because I think it's really fun. It's some of the most fun things we do, interesting things, and I think it's great that we have great academics being interested in the voting process. But during the season, we vote for 120,000 resolutions every season. It's hectic. We're not that many people. We have voting meetings every day to decide, and on the shareholder resolutions, they're more complex than many other votes. And you agree maybe it's 70% of it, you don't like the other 30%, what do you then do? The portfolio managers think this, So, the way we have solved it at least is then to be so transparent we possibly can. And I think this thing that you announce it just once a year is not a very good practice, because then it's almost too late to pick it up and criticize. And that's why we do it then 5 days before every vote. And do we get criticized because, we know the Norwegian NGOs, others really follow it and pick it up and get criticized. I tell you, when I started my job, I started after the voting season, but then my first day at work, we were criticized for a Facebook vote, and that was the front page of a newspaper. So, people really follow it and make noise if they think we're not doing a good job. But I think it would be difficult to have a process where 5 million Norwegians somehow gathered their thought. But I think to really be transparent as much as we can, and we explain we have voting guidelines, explain rationale behind the votes, which we can do even in more detail than we do today. We're going to try to do it and discuss it sort of annually. I think it's a way that at least I think works quite well.
Yeah, okay.
I don't know if it's good enough. If you thought the process, maybe you should check even more in. But I think because it's such a complex process, it's hard to really maybe get more individual input.
Yeah, and then there's a question on the slide here that we'll come to actually on that. But just before I open it up for questions, Jonathon, perhaps just a reflection from you. Of the various sort of ways in which this could become more representative, what would your favoured approach be?
Okay, so one thing you can always do is try to increase turnout of direct voters. All of these methods for mutual funds, whether we're talking about polling the individual investors or creating explicitly ideological funds, I expect them to happen, and I expect them to work in some way, shape, or form. Of course, I think there's a broader question of, is this going to contribute to any goals that we care about? There's two ways for investors to act on environmental issues. One is for individual investors to want it, and for the institutional investors to care about what the individuals want. And the other way is for institutional investors to want climate action and to not care about what individuals want. And it's unclear to me which is more likely to lead to action on climate change. It's especially because I'm working from a U.S. context, which tends to make me pretty pessimistic about this. But with U.S. investors, this is all in the shadow of the government's not doing the regulation that we'd like it to do, and probably the government has a lot of advantages in terms of being elected, one person, one vote, things like that, as compared to the shareholder vote, where the biggest economic stakeholders also have the biggest vote. There's a lot of reasons to think that the shareholders are actually going to lag behind the government in terms of their interests.
Right, interesting. I'd like to throw it open to questions from the floor. Do we have some? Yeah, we have a question in the middle at the back, and on the right over there, and whoever gets the mic first goes first. Okay, so Yuan. Yeah.
Thank Thanks. Kassadorowicz at Georgetown. Question for Jonathon. Your comment earlier about the paper in terms of looking at retail participation in terms of voting. If in U.S. meetings individuals aren't regular voters or participants, do you see some of these constructs that give a voice to the underlying beneficiaries behind the mutual funds or other instruments as creating a difference and getting that audience to participate? So retail shareholders directly aren't participating. That's your base premise. If you just give them a voice or a mechanism to express their view, which they don't have today, is that suddenly going to change? Because with retail shareholders, they have the ability to vote and they're not using it.
So let me make sure I understand the question. So are you asking, for instance, the fact that mutual funds actually vote, does that give the underlying individual investors a voice where they otherwise don't have them because they're declining to vote?
Sorry, no, I was thinking of the likes of Tumelo or Broadridge, who are actually taking up, doing a polling exercise of the underlying beneficiaries, so the investors of the mutual funds.
Oh yeah, great question. So one way to deal with the fact that most people don't participate is say, you know, we don't need a census. We don't need everybody to turn out. What we need is a sample. If you get 100 people with where everybody turns out, that's much better than having a vote of everybody with, you know, only 10% turnout. So yeah, I do think that if the goal is to provide a voice to individual investors as a whole, then these methods of polling and sampling, they might be subject to similar issues of who chooses to respond and who doesn't. But if you can get past that, if you can get high response rates, then yeah, it can sort of overcome the issue that most individual investors don't turn out.
My name's Nathan Baer. I'd just like to pick up on a thread that I think Carine and Bart started. Carine, you were talking a little bit about how first there's voting and then there's engagement and then you wait for results to happen, or you move and try and make those results happen, rather. Bart, I think you said something about we have these codes, we have these rules, we have laws, and you know, we have trustworthy managers, and that's really important because they're going to follow the rules, follow the laws, follow the norms of behavior. And we get into trouble when they step out of those norms and engage in bad behavior. And I say this being well aware of the history that Fortis and Aegeus just sort of dealt with their settlement. So what do you recommend investors do? And is it possible to maybe disintermediate a little bit the same way that investors in mutual funds are getting their voting rights, maybe they would get some legal rights to pursue some legal action?
So my opinion is that you cannot be sufficiently transparent. I think Lieve referred to it, about your purpose, your mission, your strategy, and bring it to as many of your shareholders as possible. But at the end, when it's about, for instance, voting at a General Assembly, what we see is that, okay, we know a number of days before what the votes will be, because the 250 people in the room, and we are happy, and we are trying to do more, to everything we can to have more people in the room at the shareholders meeting, but the proportion of votes that they present is so little that it's sometimes even more frustrating for them to have the sometimes results on the screen 97% pro, where the discussion was maybe a bit more critical in the room. So and there I want to jump a bit on the example of also Norges. If you have institutional investors that really invest in knowing your strategy, in scrutiny on what you're doing and what you're not doing, that engage with the company to give them remarks in time, and 5 days is good, but why not do it months before so that at the shareholders meeting it already can be arranged? If you do that, then the retail shareholder, the individual investor in a fund, should be a bit trustful in the advice and the quality of these professional bodies. Because as an individual, it's very difficult to have enough weight on what the company will be doing, And if you ask 100 retail investors, I'm not sure you have 100 the same answers.
Got a few more minutes. Question in the middle there. Maybe we'll take... Is he allowed to ask a question?
The last question.
Yeah, what I'll do is we'll... oh, okay. Well, we'll take 3 questions, and this will probably be the last trio. Guy, you go first,
Okay,
and then...
thank you. Guy Jubb from the University of Edinburgh. I was also formerly the head of governance and stewardship at Standard Life Investments, and therefore this matter of democratization and voting was an important component even in days gone by. And if I may very quickly just make one observation about democratization, it is whether actually we should, if we look forward and think democratization is a good thing, we should actually label some funds as those where you can have a vote, and some funds as those where actually you're not wanting to vote, you're wanting to trust in the manager. But if you are wanting to have a vote, I do just wonder whether people would be prepared to pay extra in terms of their management fee for that, because there is a cost to the administration of voting, and that's just a possible way forward, so that the democratization is your choice between funds which vote, will take your views into account or otherwise. If I may, I wanted, though, particularly on Carine's view about the putting your voting intentions out there in advance, 4 or 5 days, not a month. But the point that I want to come to on that is that, yes, on some you have had criticism. Have there been any where you have actually changed your voting intention as a result of that criticism, or has it informed your future voting decisions as opposed to that particular one?
Guy, thank you. Let's take the other question. Hans, if you go, and then if you could pass it to Simon. Guy, just pass it forward. Yeah.
Well, partially a question, but more a feedback, because I have the sentiment that the debate has gone a lot in the direction to really start making a change. It will come from the shareholders or the fund investors or the retail shareholders. I don't know the differences between US and Europe, but my sentiment in Europe, that is not where it is coming from. It is more the other way around. It's more managers going to their shareholders and telling them on which road they want to go regarding the topic of the day on for instance, green. And I think it should be like that, because managers should know better where the company can go than shareholders, because they are running the company, they are in there every day. And if I just make a comparison, if I look at the GLs, if I would balance the questions I get from investors versus employees on the topic, the pressure on me to put the direction is coming way more from employees than from investors today. So it's employees and clients asking questions, and then it's my job to convince the shareholders and not the other way around. But that's the feedback I want to give. But I'm not sure whether the US is in the same model, but for us, and I think for many European companies which I see around me where managers do take initiatives, I see it more the other way around.
Yeah, and I think that probably still is the default position in the US as well. Isn't it? Very interesting, Simon.
Thank you. Very interesting.
Can we just get the last question from Simon, and then we'll because then we will have to close with your answers. Yes, Simon. Simon.
Very interesting discussion. Thank you all very much. I had I think it's perhaps a slightly more philosophical question, which may be too broad for a final question. But I was sitting here thinking about democratization, and then it struck me whether we think there's any reason to believe that the shareholders in a company would think differently and have different views to the stakeholders in the company and the employees and indeed the society in which the company is operating. I was struck by the Norwegian Sovereign Wealth Fund, which is actually representing the views of all the people of Norway. But then why should the people of Norway have a greater say over what happens in relation to a Swedish company than the citizens of Sweden do, for example? And so I started to worry a little bit that we're actually taking the preferences of a particular section of society, and where we're talking about mutual fund investors, we're probably talking about a section of society, and whether or not that's really representative
of the interests of the people who engage with that company, the people who are affected by that company.
Thank you very much. Right, so we're kind of out of time, so I'll ask each of you to pick your favourite topic out of that to make a couple of final comments. Bart,
I want to pick up on the remark of Hans, and I believe it is what I wanted to say is also that at the end I'm firmly convinced that the start has to come from the corporates, the companies. They have to make the change supported by regulation and responding to what the overall consumers, investors are wanting. So it's companies that have to decide which road to follow, what their purpose is, what their ambition is, and they have just to do it, and the others will follow, I'm sure.
Lieve.
And I would like to pick on the multiple stakeholders. Yes, indeed. A company has to not only respond to its shareholders, you have the employees, you have the broader society, you have the clients, you have to think about all of them, and they have to be included in your purpose and strategy. And again, it's the transparency and the openness. And then, as Bart was saying, decent management, decent board, and good codes and good governance practices. That is what has to serve all stakeholders, not only the shareholders.
Thank you. Carine.
Yeah, to answer your question, yes, we have changed the voting intentions, not that often, but once in a while. But the point is, it's not that we sort of put them out 5 days before, and you know that, having had your job, and that's sort of, ta-da, that's a big surprise for all the companies, because a lot of times we have had lots of engagement with the companies, of course, up to that. And as you also know, we are very popular before the AGM seasons. You know, the companies want to have meetings with us, and so. But just and I agree with you. I mean, what you're saying, why should the Norwegians decide what's happening in Swedish companies? At least the Swedes will. I agree with you on that. I'm sure. But one thing I want to pick up on was on voting and having good boards. I think actually that's an area where us as investors can really be somewhat better, because 45% of our votes is really on who's going to sit on company boards. And I think there we could actually be a little bit better at, checking out a little bit more. Because of course we don't know these people always, because we maybe are too supportive sometimes of boards we shouldn't really be supportive of.
Jonathon, any final remarks you'd like to make?
Yeah, so just to respond to Guy's question, the idea of funds where you either have a vote or you don't have a vote. In some ways, it seems like we're kind of moving towards that organically. You know, you've got the blue fund and the red fund, where it's very clear they're saying, come to us because here's how we'll vote. And then we've got funds that are now polling people and sort of delegating, and then presumably there will still be funds that say, you trust us for investment, trust our votes too. We're not going to tell you, we're not going to advertise how we vote, but and you probably don't care, so put your money with us and we'll take care of it.
Thank you very much. Sorry, we're out of time now, so I haven't had a chance to get to Slido. Fascinating discussion, and I would say that overall, we've had at best a thumb sideways and maybe a little bit of a thumbs down for shareholder democracy. But, and that actually, that's not an anti-shareholder view, but more a point around actually, if we want to address some of these real long-term challenges, it is perhaps the boards of companies that are best placed to figure that out, rather than investors who may have, very disparate and varied views. Very, very interesting. Thank you very much, panelists, for a great discussion.